The Invesco QQQ Trust, QQQ, is one of the most popular ETFs and tracks the performance of the Nasdaq 100 index, which includes 100 of the largest non-financial companies listed on the Nasdaq Stock Exchange. It's known for its heavy exposure to technology and growth-oriented companies, making it a favorite among investors looking for high-potential returns. When you invest in QQQ, you're buying into some of the most innovative and successful companies in the world, like Apple, Microsoft, Amazon, Tesla, Nvidia, and Alphabet, Google. These companies dominate industries such as technology, healthcare, consumer discretionary, and communications. The Nasdaq 100 is often seen as a representation of the tech sector and broader innovation in the U.S. economy. One of the main advantages of QQQ is its growth potential. Over the years, the Nasdaq 100 has outperformed other major indexes like the S&P 500, largely because of its focus on high-growth tech companies. This means QQQ can deliver strong returns during bull markets, especially when tech and growth stocks are performing well. Let's break it down with an example. Suppose you invest $1,000 in QQQ, and over the next year, the Nasdaq 100 rises by 15%. Your investment would grow to $1,150, minus a small fee for the expense ratio. Speaking of fees, QQQ has a low expense ratio of 0.2%, meaning for every $10,000 you invest, you're only paying $20 annually. While it's slightly higher than some broader index ETFs like VO, it's still considered low for the exposure you get to top-performing companies. QQQ is also highly liquid, making it easy to buy and sell shares during market hours. This is especially useful for active traders who want to capitalize on short-term market movements, as well as long-term investors looking for consistent growth. However, QQQ has its risks. Its heavy focus on technology and growth stocks means it's more volatile than broader index ETFs like the S&P 500. During market downturns or when interest rates rise, conditions that often hurt growth stocks, QQQ can experience sharp declines. For example, during market corrections or tech sell-offs, QQQ's value can drop significantly compared to more diversified ETFs. Another consideration is its lack of diversification. While QQQ covers 100 companies, it excludes financials, a major sector of the economy. Additionally, its top holdings make up a large percentage of the ETF's weight. For instance, companies like Apple, Microsoft, and Amazon can together account for more than 30% of the fund. This means QQQ's performance is highly dependent on a few key players, making it less balanced than something like the S&P 500. Despite these risks, QQQ is an excellent option for investors who believe in the long-term growth of the tech sector and innovation-driven companies. It's particularly popular among younger investors with a higher risk tolerance and those seeking strong capital appreciation over time.